just because we've slowed down, I think people misinterpret this too. I'm not saying we're headed for recession.
Gentlemen, we've talked for a while about the economy getting weaker. That is becoming more pronounced. And one of the things I saw this weekend that I thought was an indicator for the first time since President Trump has been in office, he got booed when he went to the NFL game this weekend. And, Joe, you have talked a lot about how we gauge things. We want to take the growth rate plus the inflation rate to see how we're actually doing. But right now, with 1.5 to 2% growth and 3% inflation, you wrote about it this weekend. That's not a good place to be.
Yeah, that's not the ratio we're looking for. We'd like those things to be flipped. We'd like to get 3% growth and 2% inflation, and we're not getting that. And I look, it's hard to peg exactly where GDP is. Look, GDP is a lousy measure of the economy, by the way. And so, I'm sure that I keep saying, hey, the economy's slowing down. And I say that because of what's happening with interest rates. The 10-year Treasury note yield keeps going down. It's basically been going down since the beginning of the year. And to me, that's a pretty obvious sign that expectations for growth are falling. And now there is a question there, right? Is it falling? Are nominal growth expectations falling because what you were talking about? Is it falling because inflation expectations are falling or because real growth expectations are falling? So then we look at the TIPS market, we can see real 10-year Treasury yields, and they've been going down too. Now they've ticked up a little bit recently, so maybe things have improved a little bit. But the bottom line is that it's been a little bit of both, and most of it has been about real growth, though. And that's, again, looking at the TIPS market, we can see that. But look, I don't want to overstate this. You'll get all kinds of people coming out of the woodwork. Oh, the economy's fine. Look at, whatever, because everybody's got their own agenda and so forth, right? I mean, like for instance, let's take a look at that. You look at the GDP numbers. It's a lousy measure of the economy. First quarter was actually a negative number. I don't remember exactly what the number was, minus zero point 0.1, whatever it was. It wasn't that big of a deal. Why did that happen? Well, the only reason that was true was because companies were front running tariffs and they imported a lot more than they exported. It was a buildup of inventory of pre-tariff type goods. So that buildup of inventory was a negative for GDP. But did it mean the economy was terrible in the first quarter? Well, no, not actually. No, it didn't mean that at all. Same thing in quarter two, where you had the tariffs in place, so companies imported less and exported more, or exported, I guess, the same amount, and so therefore the GDP number looked great. But does that mean the economy was great in the second quarter? Well, no, not really. It really didn't change all that much. So those GDP numbers, you got to be careful how you interpret those things, and we'll see where third quarter is. I mean, look, Atlanta GDP now says third quarter is going to be 4%. I don't know. Maybe it is, maybe it isn't. It doesn't matter. What we're looking at is looking ahead, and that's a thing that I think that distinguishes what we do from what the market does versus people looking at data that's old. Because all the economic data that's coming out is about the past. It's not about the future. If you can be an investor, you got to think about the future. But I don't think you want to get too aggressive about trying to predict the future. So what you got to do is you got to look at markets, which are forward looking, and you think about what that market is telling you. So we look at interest rates, real interest rates, and nominal interest rates, and we look at the dollar. The dollar tells us how we're doing relative to the rest of the world. If the dollar's rising, then generally the U.S. economy is performing better than the rest of the world. If it's falling, the opposite, and so forth. There's other things that drive these things too. It's not all about just those things, just about growth and inflation. There's other things that drive the dollar and interest rates. But bottom line is we've seen a slowing in the economy or expectations for the economy as the year has progressed. We're now down to right around, let's see where we are on the 10-year Treasury note today. I'm not really sure exactly where we are right this minute, but well, hold on here. I have to find the right screen. Well, it doesn't matter. I mean, we're down around 4%, and we've been down there 4.10, whatever the number is. So we're at the bottom end of the range we've been in for a couple of years now. And think about it. Nominal growth, nominal GDP is real growth plus inflation. And the 10-year Treasury note yield is a very good proxy for nominal growth, nominal GDP expectations for the next year. or for the long term. And so right now, at 4%, you got to think about what's the split there. Well, we know that inflation is 3%. We don't know where it's going to be a year from now, but we can get some guesses on that, and it doesn't look like it's going to be coming down. So if inflation's 3 and you got a 10-year treasury note yield of 4, then your real growth component there's only 1. And now it's a little above 4, so maybe it's a little more than that. I said, it's right around 1.5 to 2 is trend, and closer to 2 really. So maybe we're at that 1.5 level. I don't know. But look, it doesn't just because we've slowed down. I think people misinterpret this too. I'm not saying we're headed for recession. Listen, I think people have this idea that the economy expands and you're in expansion mode, and it just keeps expanding at the same rate. Well, it doesn't work that way. Economies speed up and slow down during the cycle. They speed up, they slow down. So we're in a slowdown part right now. We don't know. It may very well turn higher next year. Maybe we have growth next year that's back above trend. If you think about it, if 2% is trend, that means you got to have some period of time above 2 and some period of time below 2. Otherwise, that's how you get a trend. And so right now we're in the below part. We'll see where it goes from here. We don't make any guesses about that. And we'll see. Like I said, we wait to see how the market evolves.
Steve, a lot of the government information we have is old information because of the government shutdown. University of Michigan did not shut down, and their latest consumer sentiment report, not good. How does that play into all of this?
I think it just confirms everything that Joe was just talking about, and I'm going to kind of look at this at like what's going on right now, and maybe what's some more long-term points of interest here. What's going on right here? I mean, I would hit again what Joe said is this doesn't mean you're going into a recession, right? I mean, we're not seeing that we're sliding into negative growth here. What it does mean for our markets have been having a very nice run and has some very nice valuations that, you could be concerned about a pullback here, that the market seems to be getting a little bit of ahead of itself in terms of how rosy it is. And, we've talked about this before, but maybe this is a time to, do a little selling, do a little trimming, do a little profit taking. If you've got some money to put in, maybe don't throw it all in right now. I know that doesn't make for good clickbait. Good clickbait is the world's falling apart, or good clickbait is we're off to the new AI golden age. So throw everything in and then leverage it 4x. But no, the reality here is it's probably more of a time to, just tactically be smart. Longer term, you want to be careful what you pull out of things longer term because it's longer term, and then new data can come in and you want to be flexible, be able to adjust. Don't get married to an idea. But that's sometimes more the fun stuff to talk about. So longer term, I do think, you got to put like stagflation as a possible long-term concern here. We've been talking for a while that coming out of COVID, or at least I'll let Joe speak for himself, but I've definitely been hitting. I think we're operating in a higher structural inflation rate here. We're going to have more persistent, sticky inflation, and we've absolutely seen that. I think we've seen peak globalization. I think this is going to make a tougher environment, and I also think whether you look at either party, whether you call it a intervention or industrial policy or what you call it, but we're seeing the politics go towards more of a role of the government in the economy. So sometimes if I squint hard enough, I do see some disco balls and some bell bottoms. History doesn't, repeat, but it can rhyme. And there's a reason we structure our portfolios to be able to operate in weak dollar environments, in higher inflation environments. When you take a look at the dollar, the persistent inflation, peak globalization, the demographics that we haven't even talked about. I kind of keep banging the drum of I would not do a bet on just mega cap U.S. growth stocks, throw in some bonds and go home. I think you got to have some diversification, especially for, if you do end up in more of a stagflation place, very weak or even negative growth at some point, with a persistent inflation environment. I think that's a risk you have to have some ability to deal with. Not that we're there, we're not in a recession, but I do think it's something you want to have your portfolio strategy capable of addressing because it's one of those major risks that could actually really, really put your retirement in jeopardy if you get it and you're not prepared for it. So that'll be my little soapbox today. But I do think near term there's some things to do, and longer term there's some good questions you should have some answers to.
Joe, I was going to ask you another question, but I saw you smiling, so I'm just going to give you a chance to respond to Steve.
Well, I was smiling about the bell bottoms because I wore those. I'm that old, damn it. Um, yeah, I want to come back to that University of Michigan stuff, and this is where investing gets tough. And so, University of Michigan consumer sentiment poll's been around since 1952, I think. It used to be a quarterly or semi-annual. I think it was quarterly. It's monthly now, but it was quarterly for a long time until I think the 70s they started doing a monthly survey. But that's been around a long time. It's got a lot of history. And traditionally, what you want to do, remember the old saying, right? You got to buy low and sell high. Well, how do you buy low? Well, you buy low because everybody's in the dumps, they think things are awful. That's when prices are down. And so when the University of Michigan Consumer Sentiment Poll is down where it is now, which is, by the way, right off an all-time low. I mean, here's what blows my mind. The all-time low in that poll was actually in 2022, in June of 2022, when inflation was raging and so forth. But I mean, that was still not even close to as bad as things were in the 70s, let me tell you. And yet the consumer sentiment was actually higher in the 70s than it is now. Now, that's kind of some freaky stuff. It's kind of weird when you think about it, having lived through both of these periods. But anyway, normally we would think, hey, you know what? Consumer sentiment's down at 50. We need to be buyers here. We need to be getting in, man. We need to, things must be terrible. They can't be that bad. And um, you know, but the problem is the market hasn't come down. We've got consumer sentiment at 50 and the market's at an all-time high or pretty close to it. That's the unusual situation here. So normally we would want to be big buyers here because consumer sentiment is terrible, but we're not because the market is not where we would expect it to be in that situation. Now, there is the other alternative, right? We say, hey, consumer sentiment's at 50 and there's the possibility that consumer sentiment gets better, and the market's anticipating that. I don't know. I just know that in the past, when you buy stocks, U.S. stocks, and this is only based on the S&P 500, if you bought stocks every time the consumer University of Michigan Consumer Sentiment Poll went under 60, yeah, you made a lot of money over the next year. However, I'm not prepared to do that here because it is a very odd time. Other measures of sentiment, if you get away from consumer sentiment, are not as negative. And that's where I think we're really focusing here at our firm, talking about sentiment. You look at investor sentiment, that on the other hand is not dour. It's not in the dumps. And it's a little bit of a disconnection there between, hey, I'm the economy's awful and the future economy is going to be awful because, by the way, they have an expectations poll that's even worse than the actual consumer sentiment poll. It's at 49. The sentiment poll's at 50.3, I think, which is just above the 50.2, which you had in June of 22. But so the people out there saying the economy's bad and the future economy is going to be bad, but stocks are going to be up next year. So I'm not sure about that one, but that's the way people are thinking. When we look at our other measures of sentiment, market sentiment, they're kind of moving in a direction that gives us some hope, but they're not there yet. Put call ratios. We watch the options market. You guys know I was an option trader for a long time. We watch the options market to get a feel for what speculators are doing in a sense. And when there's a whole bunch of people that are betting that the market's going to go down, or they're trying to hedge, or they're just making a bet that it's going to go down, that's generally close to a bottom. So your put call ratios, the number of puts being bought relative to calls, tends to go higher. Well, it is going higher and it's still low. That's the problem. It's still at neutral. It's not at the level we would expect to be a buyer, even though it's moving in the right direction. Same thing when we look at breadth. If we look at the number of stocks above the 50-day moving average or the 200-day moving average, those numbers are kind of sitting in neutral space. So I guess what I'm saying is that right now, with the economy slowing and expectations for the economy slowing, and with investor sentiment really still kind of hot, I don't think we really need to do a whole bunch of things here. I would also point out too, diversification. Steve said something about diversification. Best performing part of our portfolio this year is commodities, and it's not even close, by the way. Listen, we own some international stocks, which have done really well this year, up 20% plus. We don't own the S&P 500, by the way. We've talked about that many times. Some of our value stuff has not kept up with the market. Our international stock portion has kept up and actually beaten the S&P 500. But the real winner, when we look at, I'm just going to pull up an account here, a random account. Commodities this year up 37.5%. Now, we don't have a bunch of money in commodities, so I'm not saying that where our portfolios are up 37.5, but that piece of the portfolio is really clicking. What does that tell you? Listen, this is a different kind of market that we've had for the last, all that post 2008 period. That was a growth stock market. Just buy U.S. growth stocks. Hell, don't even buy bonds. They're a waste of time. You didn't make any money on them, right? You didn't have any interest rates. But this is a different market. You got to do different things here. And that's what we try to do.
We are constantly researching and looking at things. We would love to help you with your portfolio. And if you'd like that, just contact us at info@alhambrapartners.com.